So good afternoon, everyone. This is Rajendran here, joining from Market Calls, and welcome everyone to Orderflow Crash Course second session. So in this session, we are going to discuss some of the basic foundational principles of Orderflow. So let's start with some of the basic foundation principles of Orderflow here. I'm going to pull up some of the basic guidance. So this will help you to understand how to understand the order flow charts and what information you should read on day-to-day basis from the order flow charts. So some of the basic foundation principles are discussed over here. So we're going to look into a range of market activities, which is in the form of how the auction is happening, which auction is considered as a strongest auction, which auction is considered as a weaker auction, what does the volatility really means, and how does it helps in understanding the order flow charts, and what is an initiative or responsive price auction, and what is delta unwinding, what is delta positioning, liquidity, how to interpret liquidity, how to interpret trap buyer or trap sellers, and what is an exhaustion high or low, what is a high volume area, what is a low volume area, how one can make use of those information on their day-to-day routine life. And of course, one more point is missing, that is called as a delta divergence. So how one can make use of all these information to construct your trading strategy on top of this basic foundational rules, right? So that's what we're going to look into here. So first we'll look into what is the actual difference between the strong auction and weak auction. So before getting into the session, just give me a quick confirmation whether the audio quality or video quality is good, so that we can start with the session. Great. So thanks for the confirmation. So while talking about the stronger auction or a weaker auction, so primarily we'll be talking auction in the form of an auction imbalance or an one-time framing, a high volume or a higher delta. So auction imbalance you will be often able to see in the form of an thick order flow blocks, especially when you are seeing in the charts. So let me go back to the charts and I'll show you. So here is the bid-ask imbalance charts, where you can see thicker imbalance are coming in the form of the consecutive blocks over here, the shaded blocks over here, where you can see a lot of greens are coming in the form of an auction imbalance, which is most likely that more momentum buyers are stepping in this band, right? So that's what it means. So it talks about it as one form of a strong auction, a higher, more the stack imbalance you're going to see on a uptrend. It's a sign of a stronger auction, whereas a stronger auction also having the characteristic of one-time framing. So what is a one-time framing? Whereas the price is continuously making higher highs. So right, so it's pricing making continuously lower highs. Higher lows. In this case, you can see that the price is continuously making higher lows. Again, one more higher low, one more higher low again, one more higher low again, higher lows and higher lows. So when in a very good auction, you're going to see this kind of a one-time framing patterns. And whereas a weaker auctions, you're going to see a lot of overlapping activities. So you're going to see such a lot of overlapping activities are a typical consolidation or a typical sideways action. You don't find much of a one-time framing over there. So those are relatively weaker auctions, whereas the strong auctions have the characteristics of imbalance. It has a characteristic of one-time framing. It also has the characteristic of high volume, and at times with high volume with high volatility, right? So and higher delta. In fact, so those are the results of the strong auctions, whereas the weak auctions are nothing but overlap in price rotation. When I say price rotations, means I'm meaning sideways markets. Typically, it has low volume, lower delta, lower transactions, means lower participation from the markets. Strong auctions means more participation, where it results in a high volume and higher delta. Right? So here is a good classical example for the strong auction, where you can see that price is one-time framing. And another example for a strong auction, which is happening on the downside, where the one-time framing is happening completely on the downside. You can see that the auction also coming in the form of an imbalance. The imbalance is a little bit of imbalance over here and bit of imbalance on the downside here. Not much of imbalance, but still momentum sellers are coming here. Momentum sellers are coming here. Bit of momentum selling activity. So that is how a good selling auction looks like. That's how a good strong selling of downtrending auction typically looks like, right? And while talking about weaker options are more rotation. You'll be seeing a more coiled price rotations. Price will be keep on rotating in this band, right? So with low volume transactions, kind of a consolidation, you would say that, and bit of dip, and then again rise back. It goes up again, it comes back into the range. It keeps the price in a range. It keeps the price completely in a range. So that's how a weaker auction looks like. It's shallow. All the dips are shallow dips, and whereas if you look into the strong auctions, it has a very uh, powerful activity will be coming in inside each and every candle. But weaker auctions are often characterized with low volatility, slow price action movements, whereas strong auctions are faster price action movements, and it has the acceleration of the price is pretty high when compared to the acceleration during the weaker auctions. Weaker auctions, the acceleration is pretty slow, dull, boring. Right, so let's talk a little bit about volatility over here, because volatility is the most confused topics. Many people consider that volatility means downtrending markets, right? So, or volatility means whipsaw. So, volatility is not a whipsaw. Yeah, whipsaws are often related to volatilities. When I'm really talking about volatility, when all of a sudden markets are getting jittery, kind of a seesaw action, or kind of a roller coaster rides, right? So these are often compared with volatility. It arises due to change in the market participation. All of a sudden, the buyers and sellers started colliding with each other, and they rapidly started colliding with each other. That is why the buyers will took the price faster on the downside. Again, seller will took the price to the other, again to the lower side. Again, we'll be seeing a high volatile, more intensive reactions from the buyers and sellers on both the sides. At times it will be one-sided, at times it will be both two-sided, right? So it doesn't matter whichever the side it is. For example, most of the bear markets scenarios are characterized with bigger candles. So let me take you through the trading view charts to explain the volatility on a higher time frame. Then we'll come down to a lower time frame to check how it looks like. So let me go to tradingview.com. So tradingview.com is a free platform to access the charts, indicators of most of the markets. So I prefer to do a top-down analysis, if at all, for stocks, or to track some set of parameters, some basic technical analysis parameters. So here are the candlestick charts on a monthly scale. I'll narrow down to daily charts to explain what is volatility. So in a low volatile market conditions, right? So you can see the markets are moving pretty slow and steady. It's moving slow and steady. Again, you can see all the, even the downtrend also pretty slow, and uptrend is also even more slower. But when it comes to the bear markets, you see that the candlestick wicks are getting pretty much bigger over here. It often characterized by a high volatile candles, means the range increases. So this will be the bear market drops most of the times, right? So whereas an bull market, an uptrend will be slowly characterized by a little bit of volume, and a little bit of volume, and again one deep correction, and then it's slow and steady volume. So it will be relatively calm markets. And a bull market uptrend will be mostly relatively calm markets, whereas a bear market downtrends occurs with volatility. The range becomes pretty high, right? So often you can find that bear market transitions are pretty faster. The fall gets pretty faster. That means the range of that candle size increases during a bear market. Let it be an uptrend or a downtrend, it doesn't matter. The range will be a bit bigger. If you compare even the positive candle over here, the bunch of positive candles which is coming inside this block, right? So you can see that particular day's range would have been 200 points or 250 points range. It doesn't matter whether it's a positive candle or a negative candle, but the range of the candle increases. That means if you are plotting an ATR, if I try to plot an ATR indicator, ATR is one measure of volatility. Probably you would have known that by this time. It's average true range. So if the average true range itself, it is increasing. You can see that in a bear market, it typically increases, right? So it goes to an extreme. So these are characterized by high volatility, means the predictability of the markets is pretty tough. That means the range of the candle is pretty much bigger, which is followed by relatively calm markets. The volatility is cooling down. So volatility is also cycle. We move from low volatile zone to high volatile zone, again from high volatile zone to low volatile zones. So again, now the markets are again moving in a slow, steady, compressed. See that the volatility range is now getting reduced. All of a sudden it increases, but then it slows down. It increases and then it started slowing down. But relatively, we are facing an low volume, low volatile markets. Even the current the current attacks, the terror attacks which happened, and India and Pakistan exchange fires, right? So, but despite that, the volatility is still maintaining lower, right? So the range of the candle was one of the day it was bigger, but then still can see that the range is quite similar to what we experienced in the past. Right? If at all it is it's one more time we're going to see a bear market, we'll be seeing a spike in the ATR. That means the range of the candle increases. It's never been a slow and steady, dull, boring corrections. Most of the time, the corrections comes pretty faster. The range increases, the volatility increases. When I'm talking about volatility, I'm talking about the candlestick ranges, right? So in this case, in case of in case of um, in case of order flow, right? So whereas when people are talking about in TV channels or in other places, when they are talking about volatility, they mostly means bigger consolidated sideways market. So their time frame differs when people are talking about volatility. In my case, I'm talking about the range of each and every individual candles, right? Okay, coming back to the point over here, and probably the best example to see the volatility is the Bitcoin. To visualize, so it's BTC USD. So sometime back, the Bitcoin was crashing. When it is going up, you can see that the initial most of the initial bull market phase, right, it is often characterized with low and steady volumes. It's slow and steady. You can see that slow and steady. It's taking a long time to reach a certain point, right? And at the end of the bull markets, when the bull market is reaching its peak, you're going to see a big volatility followed by a big volatility on the downside as well. So volatility will be there on the upside as well, because the range increases when it's reaching the peak. So it will be very slow and steady, slow and steady, slow and steady, slow and steady. And when it is reaching a bull market peak or very close to the peak, you're going to see this kind of actions, these kinds of bigger actions, and followed by bigger downward corrections also. So not only bear markets are characterized with higher volatility, even at the very close to the end of the bull market, you're going to face the higher volatility followed by a higher volatility on the downside. Like it's kind of an uptrend also high volatility, downtrend also high volatility. So high volatility can occur at any places. Even the downward drop also high volatility, and upward also high volatility. Especially the V-shape reversals or an inverted V-shape reversals when markets are falling faster and recovering faster. It is characterized by high volatility. And when the market is dropping down faster and recovering faster, that is also characterized by pretty higher volatility. And now, if you see that the volatility has been pretty much reduced, all of a sudden it shows volatility one of the day, but the next other days we'll be seeing some of consolidation, a lot of consolidations, a lot of slow and steady corrections. And you can see that, so the entire phase, the volatility was inching up, and then it started cooling down, and then it reduces. That means now the intraday opportunities are pretty less. If you want to deal with less and less volatile days, very rarely some of the days will be turning into an 5% returns or a 6% returns. Most of the times in case of Bitcoins, we'll be finding 0.5% returns or less than 0.5% returns, dull, boring returns, because the volatility is dead. Right? So the volatility is completely dead. That is how it will be. But if you look pretty closer on the hourly time frame or some other time frame, the volatility might be showing up all in a sudden. Different time frame, the volatility cycle increases. You can see that volatility again goes like a cycle, like it increases, again decreases, again increases, it decreases, right? So wherever you're seeing the decline in the volatility, it will be followed by very less amount of ranges. The range of the, so you can see that they are relatively calm markets. They're very calm, whereas volatile movements are mostly directional movements. At times, yeah, bigger choppy markets, especially when the RBI announcement is supposed to be announced. Until then, it will be a relatively calm market. Once the event is out, market becomes volatile because the participation itself changing. The nature of the participant changes. So more aggressive players are coming into the picture. Higher the volatility means more aggressive players are coming in. Probably high volatility is often characterized with low liquidity. Low liquidity, high volume. It results in high volatility. And also high volatility is also characterized by high volume and higher liquidity, higher transaction volume. That is also characterized with higher volatility where the candle ranges increases, right? So that's the basic explanation for what actually volatility is and what we are looking for. And coming back to the slide, especially event creates volatility, like the RBI policy announcements, GDP data, earnings. The trading range will be higher in a high volatile situations. Lower trading range in a low volatile situations. High volatility doesn't mean like high volume. A high volatility can also happen in a low volume environment also, especially in a low liquidity environment. High volatility is very much possible. And a high volatility can occur with a high volume also. It can occur with a pretty low volume also. So often, as I said, high volumes are characterized by bigger candle ranges. Again, bigger candle ranges over here, which is a relative measure. So if you understand Nifty futures or Bank Nifty futures, let's talk about Nifty futures. A 5-minute candle which is making a 30-point movement or a 50-point movement in a matter of 5 minutes, it's a high volatile candle, we can say that. Or if it is moving 5 points, 10 points, which is a very casual movement. So it's a relative measure. It changes script to script. There is no definitive thumb rule to say that, but it's more of a relative measure. If it is Bank Nifty, I would say that within a 5 minutes, if the Bank Nifty is jumping 100 points, or the entire range was 100 points, so that to me it is a high volatile. Bank Nifty is a high volatile instrument because all of a sudden it moves. It has the capability to move 100 points, 150 points in a matter of 5 minutes, right? So those candles we call as a high volatility candles. And here comes the most interesting part, the initiative and responsive price action. So first we'll talk about what is an initiative auction and what is a responsive auction, what is the difference between the two. Initiative auctions are mostly directional auctions. Responsive auctions are typically mean reversion auctions, right? So most of the time an initiative auction and responsive auction, often both the characteristics is that both has high volume transactions, right? But in an initiative auction, let's say an initiative drive is happening, the delta will be having a directional delta drive. For example, if the prices keep on going up and up, price keeps going up and up and up, you'll be getting a positive delta over there. The delta becomes positive, the delta becomes positive here, and delta becomes positive over here. The volume of the transaction of the price, you'll be seeing a very good volume transactions over here. And typically when it comes to Nifty futures, you'll be seeing volume like a good flow of 3,000 lots, 4,000 lots, or 5,000 lots in each and every candle. And the delta also having a directional delta always maintain positive. That is more of an initiative auction, right? So that's more of an initiative action or initiative auction or initiative drive, whatever the name, there are the different names you can call it up. And next comes the responsive price action. Responsive price actions are one form of accumulation or distribution, right? It often characterized with, it is also characterized with higher volume, right? But a reversal delta means kind of an absorption happens. So when the price keeps going up, and it mostly rotates within a range, right? So it mostly rotates within a range where the extremes, the price extremes are characterized by high volumes. So maybe it shows high volume buyers here, high volume sellers over here, again high volume buyers over here. I mean high volume sellers, again high volume buyers. High volume, at times it will be characterized only by high volume buyers, but despite that price used to fall. That is also responsive buying, I mean responsive selling. And when the price reaches the bottom, you'll be finding only big buyers are pushing the price up. So that is also means selling activity has been completely absorbed and big volumes are resulting at the edges. Mostly it is characterized by high volume at the edges, high volume at the edges, and high volume at the edges over here. It doesn't matter whether it's buyers or sellers, but extreme zones, the extreme range bound auction, it's more of a sideways auction, but volumes are bigger when it comes to the responsive price action. To explain this, let's go and take the recent Nifty futures example to understand how the absorption activity was happened last Friday. Like, let's go and check the charts. So let's take about this particular example. Maybe I have one more strategy with me. It's better to talk about that. So I kept under PC, D drive, Orderflow drills. So kind of a breakout absorption strategy, right? So look into this example here. So this example, the buyers and sellers activity are extreme at the highs. You can see that every time it reaches the high here, some bigger transaction is happening over here, and whenever it is reaching the bottom again, some bigger transactions are happening at the bottom. So every time the price is reaching the upper extreme, some bigger transactions are happening. Every time it reaches the lower extreme, momentum is there, but still prices keep on absorbed by all the selling activities absorbed, and responsive buying happens. And at the end again, responsive buying happens over there. So a typical example for an absorption here, where the price is mostly range bound. Typically it's moving in a range bound auction, right? So you can see high volumes are coming in, but then it most likely getting absorbed, right? So again, high volume activity here again getting absorbed. And now, so every time price is reaching an extreme. So in this case, both extremes are dominated by the higher volumes, typically higher volumes in the bottom. And again, price shoots up with a lot of momentum, but despite that, price used to drop. So the rectangle which I marked here, which shows how the absorption activity happens. And despite the momentum, price is being absorbed. The buying activities are getting absorbed over here. So buyer showed up with a momentum, and then it is absorbed, but still price used to fall down. Now selling momentum is seen, but despite that, buyers are coming and supporting. And in fact, buyers are coming and supporting over here. Now, despite all the buying transaction happening over here and buying transaction happening over here, price is falling down. Now look into the subtle difference over here. This we call it as an absorption, right? So so every time price is reaching the extreme, the activity is getting completely absorbed. So I'm going to stop the session here, and let's get back to the slide. So at times the activity can be initiative, at times it can be responsive. The example which we've seen now is purely responsive auction, whereas an initiative auction is like more of a directional auction. In case of the previous example, if you look into the delta values are kind of a mixed values. You can see a negative delta, positive delta, negative delta, positive delta, positive, positive, negative delta. So that you're going to get some such kind of a mixed delta points over here. Whereas in case of an initiative drive and a strong uptrend will be characterized by a strong positive delta, right? Whereas a strong downtrend will be characterized by a lot of a negative delta over here. Markets also goes down, we'll be having a directional momentum. The sellers will be clearly pushing the market clearly down in a directional way. That is how an initiative auction looks like. Whereas at times the initiative auctions are the result of price traveling in a low liquid zones. So to summarize, initiative auctions are the result of price traveling in low liquidity zones. velocity of the price, or the fastness of the price, or the tempo of the price. Velocity is also called as a tempo. Tempo means how fast the market is moving. If the price is pretty high, initiative drive. Whereas a responsive option, price travels in a high liquid zone. Typically liquid zone. More means more limit orders, more limit orders are crowded at a certain price point, price range, you can say that. Where institutions like to accumulate or distribute. So that's what it typically happens when there was a responsive auctions. And for example, let's say the market, we'll take an example of ICICI Direct, right? So ICICI, or let's say ICICI, ICICI Securities, right? So they also do a lot of operations for their client, and let's say they're running a fund. One of the fund they want to buy, let's say Reliance, they purchase Reliance. They want to purchase 1 lakh quantity of Reliance in the next 2 weeks. The goal is to purchase, let's say, instead of naming a fund, let's say a local mutual fund. A local mutual fund wants to purchase 1 lakh of Reliance shares. Next 2 weeks, right? They have the sufficient funds to accumulate, but at the same time, they cannot go and punch 1 lakh shares of Reliance in one shot. That might impact the market. Or then at the same time, there won't be much of an buyers. 1 lakh buyers may not be available at that particular instant. So they have to depend upon liquidity, right? So they need more counterparty to go and trade. So one way is to drive the liquidity. The other way is to acquire slowly and steadily. We call it as an accumulation. So one way is to accumulate slowly and steadily. So now in the markets, there are a couple of algorithms are there. There are VWAP algorithms or TWAP algorithms. Right, many algorithms are there for institutions. Some algorithms like iceberg orders. So there are many algorithms out there. If you want to understand what kind of algorithms are there, I can give you a document which is mostly available in the internet. So let me search it out for you. Let's say we want to look into VWAP, TWAP, iceberg. So there are many order types which is available for the institutions, which explains all those order types. So there are a couple of slicing which is available there. So maybe I think this one will talk about. There it is. So now all these things are automated now. VWAP execution, TWAP execution, time slicing, iceberg orders, some order routing, right? And maybe now many examples would have been available there on the internet. So VWAP, how the VWAP get executed, our TWAP orders got executed. So most likely they are these algorithms are used to get a better fill so that the institutions might not their transaction cost will not increase. So all these TWAP, VWAP are institutional tools to check are they getting a better price, right? So and the orders, some orders get executed when they really look for liquidity. So if the liquidity is there, accordingly they place the order. Some of them they do a time slicing, so they'll be sending in packets. Every 1 second they'll be releasing 100 quantities, 100 quantities, 100 quantities. So they'll be acquiring very slowly so that they don't impact the markets. And some algorithms are pretty low, rogue algorithms. When they're finding a big buyer or a big seller, they do a transaction. Otherwise, they'll be doing very less transactions. So those are mostly automated algorithms these days. So they switch on the button and then it keeps on happening during live market hours. Right. So possibly you can look into this. What is the characteristic of a particular liquidity seeker? Let's see what this particular algorithm looks into. It seeks liquidity in both regular and dark. Of course, we don't have dark pools, right? So, but there are mature markets. So especially when you want to liquidate or you want to do a fire sale, right? So you want to find a counterparty liquidity. Whenever the liquidity is happening, it's just kind of a rogue algorithm. We can say that. So it's patiently to highly aggressive. So whenever you want to do a fire sale, so institution they call it as a fire sale. So the characteristic is that does not aim to complete. It does not participate in opening or closing by default. Maybe during middle of the day, the strategy looks for liquidity. If there are, when I say liquidity, that means more limit orders are there, more counterparty limit orders are there, and it goes and seeks those kind of liquidity, kind of a rogue one. So it's mostly uses IOC, immediate or cancel kind of orders. Like you are sending 2,000 lots, and the fill will happen only if there are 2,000 lots are getting filled. Otherwise, it cancels. It will not look for a partial fill. It's kind of an I have 2,000 lots of Nifty. I'm sending in one shot. If somebody is available at 2,000 lots, then it'll get me the entire fill. It will not look for a partial fill. Partial fill, it automatically rejects those orders. Right? Those orders will not get executed at all. Right? That IOC is one form of order, right? Immediate or cancel. Right? So that means if there is a counterpart liquidity, then give it to me. Otherwise, don't execute it partially. It executes in one shot. You do an execution. So there are many different order types out there. Like one is a liquidity seeker, another one is an iceberg order. So what is an iceberg order? It shows only the small portion of the order. Most of the orders will be hidden. Probably you will not be able to see from the limit order book. As I said, only 90% of the orders can be hidden. So iceberg order, it shows only a tip of the iceberg, and it used to specify the size that's shown on the order book. So at times what happens when the institution, they don't want to move the price above a certain quantity or below a certain quantity, they'll float with an iceberg limit orders. Right? So a lot of orders will be sitting over there, crowded orders. Whereas when the price is traveling in those zones, you'll be finding that price started moving sideways because now a lot of liquidity has been put over here. It's tough for the price to move above that. If at all they want to move, they have to push up through all the orders. They have to eat up all the orders to move the price from point A to point B. Right? If more orders are there, price usually struggles a lot. Something like this, and then you'll be finding all these zones. You'll be finding delta will be positive because aggressive buyers will be pushing really hard, but they may not be able to get through those liquidity zones, and eventually price they tend to drop. Right. So whenever such kind of when the price is hitting in a high iceberg order zone, what you'll be seeing is the very first thing what you'll be seeing is a very higher transactions. So the higher transaction is what you're going to see. Then price moves into sideways action, and then price drops. That's what most of the iceberg order characteristic you might be seeing, especially if it's coming at the day high, right? So most of the iceberg orders are a result in a kind of an environment called trap buyer or a trap seller, where a big buyer might get trapped at the day high, or a big volume transaction happens at the day high, despite that market started dropping, or a big seller might get trapped at the day low because of that iceberg orders, right? So there are a couple of you can find a lot of research materials on what an iceberg order is all about, what is a liquidity seeker algorithm does, right? So there are some 10 to 12 types of order types which is mostly used by the institutions, right? So again, percentage of volume, this is one form of execution. And of course, this is also available in Nest trading terminal. Some of the broker enable such kind of tools to the institutions, but it is not available in a normal IBT trading terminals, right? So in a normal IBT trading terminal, you don't have that facility to execute this kind of stuff. But still, the players like Thomson Reuters or the Nest Omnisys they have such kind of features for institutional clients, right? And these kind of algorithms, TWAP algorithms or VWAP algorithms, you just key in the values, how many seconds you want to execute, and how frequent you want to execute. So you can set the start time, end time, and you press the start button, automatically it keeps selling, right? So it's some initial settings, and you press the start or buy or sell, automatically according to your parameters, the values start executing over there, right? So there are many ways to look into that. I think maybe Omnisys might have Omnisys iceberg order, right? So I think probably they sometime back they have an yeah, here maybe this, here you can find some interesting tools, the documents from Omnisys. So you have an idea about how the iceberg order, how the VWAP order or the TWAP orders are getting filled. This is basic trading features, but I think here also it is not involved here. And it's not talking about institutional algorithms. Anyway, sometime back I have that set up. So maybe here some execution based algorithms. So here probably it's nothing but the information which is coming from the iceberg order, right? So Nest provides such kind of features, and maybe it has to be, it's a feature which is provided to the brokers. Not every broker have this access. So volume based participation, time based slicing. So all these things, if and only an institution can use it. Sweep to fill, right? So all these are, you do a setup and then one shot you press the button, all of a sudden start running those algorithms. Scale, active, relative. So all these are some of the algorithms which are practiced worldwide by the institutions. Pegged to markets, midpoint match, market if touched, limit if touched. So these are not, these kinds of algorithms are not available for common people like us. And discretionary order, bracket orders, and those orders are now available. But otherwise, the iceberg orders, probably you'll be seeing the Nest trading terminal. You have to punch in the quantity and price, and you put an iceberg and the order validity, how many hours or how many minutes you'll be able to set over there, and accordingly the iceberg post small orders into the markets. It just keeps on floating the markets within orders, right? So that it will not be posted in one shot. So let's say packets of orders will be coming in. So if you look into the limit order book, you may not find a difference, because it floats in, it floats the orders, and moment the buyers are eating up, and again it floats at the same level. Again it floats limit order at the same level. Again liquidity is getting eaten up. Again it floats at the same level. So it means that limit order, you won't, if you look from the limit order book, you won't find the difference. But if you look from the perspective, more price activity, price is mostly moving in a sideways band, whereas the limit orders will be getting filled again and again. A refill will be happening again at this level by the limit orders again and again and again repeatedly. The iceberg order floats, usually in the form of small orders, right? So it keeps on refilling those levels, exactly at those levels. Nobody will plot and all of a sudden 1 lakh of quantity will not be floated over here. So if it is there, then everyone will be suspicious. So without suspicion, the small packets of orders will be continuously floated at a certain level, and that's how an iceberg order looks like typically, right? So you can see, price order is mostly in limit order types, and you put an buy quantity there. So again and again, repeatedly, the buy orders will be getting filled at frequent intervals. And it also have an order validity, and it cancels on its own when certain the expiry is over. It automatically cancels. Right. So again, there are a couple of examples given in this page. You can go through those examples. Anyways, coming back to the types. So we're not going to discuss more into the order types. Maybe we can have some other community webinar session where we discuss those execution algorithms. Right. So sometime back, I attended during 2014. I attended one of the Omnisys. By the time it was Omnisys, now it is Thomson Reuters. So they given me the demo of execution algorithm. Right. Of course, I was sitting at the broker's office end. So every time there was a new feature implemented in the Nest, they used to give a demo. So one of the day where they given all these execution demos. So I gone through all those execution algorithms which is used in Indian markets. Right. Precisely, more or less, it's the same international standard. Everywhere, the institutions follow the same standard there. And yes, so we are talking about initiative and responsive auctions. So there are different ways and initiative auctions can happen. So especially when institutions want to drive, we talked about a local vendor, right? So local mutual fund. So local mutual fund, they want to acquire, let's say they want to acquire, accumulate. So 1 lakh shares of Reliance next 2 weeks, right? So that is the goal given to the dealer. The dealer will execute it on his terminal. And of course, all the high-end analysis would have been done fundamentally, or some technically they would have been approached the markets, and then they would have figured out the solution. They figured out that we want to purchase 1 lakh Reliance in the next 2 weeks. But the goal of the dealer is to not to impact the market much. Without impacting the market much, he have to go and accumulate slowly and steadily into the markets. Otherwise, if you're going to punch 1 lakh Reliance in one chart, maybe that might impact the market relatively huge. Probably that could move the Reliance by 5% or 10%. So they don't want to move, even though they have the potential to move the markets. But in order, if you're going to move the markets, that also increase your buying cost. Your buying cost will be radically, you will be incurring more slippages. We call that as a slippage. Instead of you getting at 11,000 rupees, your overall cost increases to 11,100, right? So there will be 10% slippage, which is pretty huge. So you don't want to impact Reliance much. So what they will be doing is that initially they will be finding liquidity zones where the counterparty is willing to give more trades, or where more people are interested to transact more. So what they will do is that they'll be doing, let's say Reliance is at 11,000. So 11,000 now, and so they'll be pushing the price, they'll be moving the price in such a way that they'll be trying to find the liquidity. So they'll be pushing the price as long as they are finding the liquidity. So once they find the liquidity, right? So let's say Reliance moved from 11,000 to 11,025. 11,025. When the price is reaching 11,025, maybe now more participation happens. More people might be willing to do a transaction. That is where you'll be finding more limit orders over there. More limit orders would have been floated. Many people might be willing to do a buying and selling in this transaction. That is where they'll be able to acquire more and more shares. Probably this will be requiring only 10K shares to move from point A to point B. Here they'll be able to manage to accumulate some 40K shares. Let's say 40K shares, they'll be able to accumulate slowly and steadily. So probably some half of the lakh would have been completed. Now again, they'll be driving the price up to find the next liquidity where more people are coming to do a buy or sell at a certain price level. So these are the one which is characterized by initiative drive. The initiative drive, or I'll call that as an ID. ID stands for drive and I stands for initiative. Okay, maybe the D was really looking bad. So ID, and here are the auction we'll call it as a responsive auction, and again further initiative drive. So the responsive zones is where the real accumulation happens. The real accumulation happens, and an initiative responsive auction, initiative responsive initiative can also be like this. It will be initiative, duo distribution, and then again an initiative, right? So it will be initiative over here and responsive at the top, and it can be initiative. A responsive to responsive is typically an range bound scenario where the edges are having heavy volumes, and there'll be a bit of break. Again, it results in again one more responsive auction. So that's how a responsive to responsive auction will look. So it breaks. Again, it will be characterized by slow and steady responsive auctions where the volume transactions in these blocks, the block number 1 and block number 2 and block number 3, the volume transactions are pretty heavy at the pivot edges, right? So that is how an initiative, that's how a responsive auction looks like. There is a very subtle difference between the responsive auction and the consolidation. The responsive actions are often characterized with high volumes, whereas consolidations are characterized by pretty low volumes. And there are times market also does initiative to initiative, which is usually comes in the form of an momentum. So initiative drives are mostly momentum drives. A momentum drive with big volume, followed by a momentum drive with a down volume. So mostly some of the reversals in the markets are characterized by initiative to initiative, which often gives a subtle odds from the scalping point of time. As you'll be able to recognize those initiative to initiative drive in form of an upside reversals or in form of a downside reversal. You're going to see this in V-shaped reversals. Always the V-shaped reversals are characterized by initiative up to initiative down. So it'll be like initiative up to initiative down here, where the volume will be pretty much higher on both the initiative up drive and initiative down drive, right? So it's always good to know what stage we are in. Is it an initiative auction which is happening or a responsive auction which is happening, right? So there are times an initiative auction will be forming, especially when the price is moving in a range bound. Let's say price is moving within this range, and you're finding the price auction is happening in a responsive mode. So price auction is happening in a responsive mode, and probably the break of this level, the auction might change from responsive to initiative. So maybe we might be incurring a responsive auction here, responsive auction here. Whereas when the break of the level, you're going to see an imbalance zone. Imbalance are nothing but trending markets. We call it as an imbalance. Or at times it could be some auction imbalance in the form of an initiative drive. Right. So here the responsive auction after a breakout, it turns into a initiative drive again here in this example. So coming back to the point, so we looked into what is an initiative and what is a responsive auction. Let's have a look into the high volume area. High volume area plays a major role in the markets. Of course, higher volume area means higher participation activity, right? So higher volume is always a result of markets traveling in a high liquid zones. Whereas low volume area means price is traveling in a low volume zone. Maybe less participants are interested in those zones, which you can be able to see from the market profile charts. If you look into the market profile charts in Nifty, right? So if you compress the activity over here, you can see next to the price profile, you are having a volume profile. You can see that the volume was relatively high at this peak, and at this zone, especially at 10,917 or 10,914 levels, the volume was relatively high. That's what the histogram shows. The volume histogram shows that volumes are relatively high. And at the day's edges, you can see that volume thins out. So at the day's high and at the day's low, volume typically thins out. You can see here, volumes are thinning out at the day high. So one of the day high. Price is also spending less time. Volume also pretty less, because at the day extremes, the volume transactions are pretty high, but more activity happens at the center. So more activity was happening over here, and high volume is happening over here. So that is one way we interpret how the high volume transactions happens. But then we also notice that high volume transactions, especially when I'm marking a zone. Let's take a nifty example over here. In this case, let's say an 15-minute charts. Right, I'm trying to, let me compress this activity. Let it be Nifty futures. Nifty futures. Maybe this is not the case. Kept under WAP selection. Yeah. Let's say 15-minute charts in Nifty futures. So what you can see from this chart is that I'm going to select a consolidation zone, a typical consolidation zone I had selected, right? So from point A to point B. Is this the one? No, this is not the one. So the recent consolidation was here. If you look the recent consolidation band, more price-based consolidations happen in this band from point A to point B. Point A to point B. You can see that more activity, more volume activity was concerned over here. There is a yellow color line. If I draw a horizontal line at that yellow line, you could see that the high volume activity, players are coming and buying at those levels, right? So not only it happened once, but it happens 4 times in a row. So exactly buyers are defending those levels. Buyers are again defending those levels, and buyers are defending those levels, right? So again, that is this same feature is also there in the same feature is also there in Bell Market Profile Ultimate. So I'll show you how it works exactly in NinjaTrader. Then I'll try to give the context to it. So context is also one major thing which is pretty important, which comes with market experience, which comes with screen time. So what I'm going to do here is that the same Nifty chart, I'm going to pull up, let's say, I'm going to pull up, I'll pull up Nifty 15-minute time frame charts. So end of March, I'm going to pull up 15-minute time frame, 15, and I'm going to press OK.
No. Voice is less.
Yeah. So let's look into this 15-minute chart example, right? So in this case, what is most likely to, what I'm going to do here is I'm going to right click and go to indicators. So Bell Orderflow Ultimate, Bell Market Profile Ultimate. Here there is an provision to display into a normal profile as well as dynamic profile. So when I choose dynamic profile, and let's say I'm gonna say like I want to enable candlesticks and remove the TPOs. I don't want the TPOs. I want to display only volume profile. So and press OK. So in that case, I'll be able to select from point A to point B. Let's say the start of the bar. I'm going to select the start of the bar. This is my start of the bar, and I'm going to select the end of the bar. So automatically it draws me the point of control levels. So in fact, I will be also able to I'll be able to do a bit of adjustment here. Let me close this. I'll do a start of the bar, say from this bar to the end of this bar, where I'll be able to draw an prominent point of control, where more volume activity is happening. I'll be able to say that. So that you can go to indicators. Probably if you want to watch the volume levels, then you can use a bigger histogram, so say 30, so that the histogram length gets bigger. Right, so you can see one of the high volume areas. So these are high volume areas. You can see high volume areas in these bands, high volume areas in these bands. Whenever you're seeing a high volume area getting initiated from that exact level, right? So that is what precisely we can say, like the short-term activity is getting crowded over here. Short-term activity is getting crowded over here. Temporarily it brings some good push, but from a positional perspective, everyone loses there. But when more and more activity, when more and more price activity is happening at a high volume area, right? So that means that's mostly an short-term buyer. Players are buying and buying and buying. Many times they bought over there, which mostly means most of the short-term players are having the stops around the zone. Mostly it's short-term players. So next time what happens? Mostly it will be taken in the form of a gap down, and price tend to move further lower. Right. So this is a behavior which I shown in the couple of past examples as well. Right. So this is a repeated zone. Repeatedly, we can see these kinds of setups. Again, you can see one of the time price is coming exactly to that high volume area, and again price is shooting up from there. So which is nothing but the players are accumulating at high volume area zones where more interest already developed. People are considering that as a resistance or a support. In this case, it's a support over here, and again supports are over here. Supports, many times players are responding over here. They are mostly traders, right? So this kind of behavior will be able to listen from mostly from the auction market theories. Typically, you can find where people go and take the trades. Many people find the high volume area as a support zone or a resistance zones. They're mostly, who are taking decisions there are mostly short-term players. Right, and here in this case, I can have multiple bars over here. So I'll be able to take, you can see there one of the day, the players are coming and resting exactly there, not only once, but twice. They are resting over here, and the drive is getting initiated, and the very next day market is trying to take down those references, because those drives would have been mostly initiated by the traders, because they would have been seen the past high volume area zones, and then they might be using that as a support zones to drive it. So most likely weaker hand does that most of the times, right? Yeah, any questions? I'm going to mute. I'm going to unmute here, so you can ask only relevant questions what we had spoken so far. Yeah, questions. Any questions?
No,
Yes,
from responsive drive to initiative drive, how to identify normally?
I'm going to explain that. So I'm going to explain over that particular strategy.
Okay.
Right. So let's look into that strategy. Right. I'm going to mute everyone.
Can we predict the initiative drive?
Yeah, you can predict the initiative drive at most of the places. Yes. And that comes with an experience, right? And that doesn't comes with there are no rules saying that, but repeatedly you're going to watch the market. There are repeated patterns which you are going to experience. All you have to do is that every day you take your pen and pencil and then try to record your understanding where the initiative drive came, how it came, and why it came. Right, that is the primary reason. You have to keep a logbook, and we call this a trading journal, where you're going to keep recording each and every day of activity. You're going to pen down, or probably you can write it in the form of a blog, or you can store it in the form of documents. Right? So every day you take the screenshot and write your recordings taken notes. That's how your learning experience increases on day-by-day basis. Right? In my case, I'm talking on daily basis. I'm talking about we are talking in a Slack. Routinely, we are talking about we are observing the markets. We are looking for an initiative drive information or a responsive information. How a responsive activity is converting into an initiative activity. We are routinely practicing those information. Likewise, you also have to go and practice it, and over a period of time, you will feel the difference within you as a trader. You're moving to the next level of watching the market generated information. Right. So one of the strategy which I'm going to discuss here is the absorption strategy, which I ran a couple of minutes back. I'm going to rerun it again to check how an absorption happens in the markets and how the transition from absorption to initiative action happens, and what is the subtle differences one can measure from this example. Okay, the strategy which we are going to look into is the absorption breakout strategy. And as I said, the balance, we call that as a balance, right? So balance is nothing but where the price rotation happens and kind of a sideways option happens. The edges are dominated by the momentum auctions. So momentum buyers are there, and on the downside, momentum sellers are there. And again, at the upper end, again, momentum buyers came. I think it's a video of almost 5 minutes. I'm gonna to save some time. You can see big volumes are happening, and again, price goes to the edges. Price again goes to the edges. You can see a lot of momentum there, and despite the momentum, price used to fall down in this example. You look into the delta was kind of a mixed transactions. Pretty mixed, but absorption responsive buyer showed at the bottom and the responsive seller are showing at the top. That is why, despite the big buying activity, sellers are responding, and despite the big selling activity, buyers are responding, and big momentum buying is happening. Despite that, market tend to fall. So these are the characteristic of responsive buyers and responsive sellers on both the edges. At times we will be seeing only responsive buying, and then market falls. It immediately becomes responsive to initiative auction. But here it's kind of a responsive auction, which is happening on both the sides. So what one have to look for is that kind of a range breakout strategy. So a range breakout can be employed over here. Before getting into the range breakouts, what you'll be seeing is an ultra low transactions, which is happening before price is breaking out of the range, right? So you'll be seeing the volumes are getting thinned out, seeing a lot of zeros. You're getting a lot of zero fills over there. Volume, you see that there are no, not more than 100 volumes or not 200 volumes over there. The volumes are getting thinned out. And now probably the breakout might happen, especially after a thin volume. You should be on a high alert mode, especially when the volumes are getting dried out. That means the entire limit order book would have been exhausted at those zones. Liquidity would have been completely dried out at those levels. So after a responsive activity, how it happens, especially when more activity happens, that results in a more volume, but price moves completely sideways. And then you can see that again the volumes are relatively thinned out over there at the edges. If you look at the lows here, it was 132, 121. One of the examples we seen in yesterday's trading room, like the volumes are getting thinned out at the day's low, right? So the day's low is having only 25 volumes, 121 lots, 111. Now again 32, right? So it's just getting thinned out and thinned out. And now it's taking a break. So that's a Bank Nifty example here. So price is breaking the range. You see the volatility is increasing. The volume of transaction is increasing now. It's taken more time to show the momentum sellers. No one can really anticipate the momentum sellers because now the price is taking a directional opinion. You can find a lot of momentum sellers there. But that subtle change, you'll be able to get inside the balance itself, which side the balance price is about to break. Or at least you know that this is the time I should be ready to trade the breakouts. Now those zeros are nothing but a characteristic of initiative drives. Now that means when you're going to see a lot of zeros down there, that means price is going to travel in a low liquidity zone. And that is also result in high volume transactions, higher the volatility. That is the characteristic of the initiative drive. So these are the zones you should not fight for reversals unless you have the context in place. Something like a momentum auction reversals or momentum exhaustion setup or a V-shaped reversal. Only in those cases you should fight. Otherwise, it's a strong auction. One should not fight at those locations. See the volatility of the candle is increasing. That means it's initiative drive with high volume and higher ranges, high volatility. But price is traveling in a low liquid zones. That's why we are getting more and more zeros in between the candlestick zones. So that's an interesting example to understand how the transition from responsive to initiative auction happens. There are a lot many examples I'm going to show over a period of courses. We'll start. We'll complete the basics of basic foundation principles, and then we'll talk about more and more trading strategies. Right. So, are we looking to trading strategies side by side? We'll cover some of the topics, and then we'll discuss some of the trading strategies. Again, we'll cover the basics, and we'll cover the trading strategies again. So now, what we're going to do here is that we can take a 15-minute break, and then we'll come back and we'll resume the session. So I'm just back now. So let's start looking into the high volume area. So high volume area is where many participants also they position themselves. For example, many times what it used to happen is that when the price started moving up and all in a sudden they might be coming in the form of pretty heavy packets, right? So they might be the buyers might be positioning themselves here. Of course, maybe I'll change it to a different color. Let's say the buyers might be coming in the form of an packets. So they might be positioning themselves in a high volume area. So those zones, when next time when the price is moving away from there, when the price is moving away from there and price is coming back to this zone, what you'll be seeing is an high volume absorption. You're going to see some sort of an high volume area absorption at those same locations. Let's say again when the price is reaching the zone, volume gets a bit heavy, and again absorption happens over those zones, and those zones are usually results of an continuation, right? So they used to continue from there. So that is where you're going to see some sort of an absorption, and probably absorption happens over here. Look from the order flow perspective, you're going to see absorption. You're going to see some sort of an absorption in this band, right? So absorption. So what does that mean is that the participants who position themselves. So here you're going to see some high volume area. So I'll say like HVA, high volume area over there. Whenever the price is coming back to the same reference level where the participant position in that band, you're going to see absorption and price tend to make an upper move from there, right? So, and that shows the interest parties are responsible for adding more to their position. They might be reloading their positions again at the same interval, and those are the zones you might see in that price might dip a little bit, but then absorption happens and price moves in one direction, right? So high volume area is also shows that the interested parties are and where the higher transaction happens, where smart money themselves used to position themselves in the markets, or let's say instead of taking a support over there, when you're seeing that price is about to break that particular zone, and the price is breaking down that zone, a lot of unwinding, the position unwinding happens. The participant who entered in this band, they most likely unwind. You'll be seeing an initiative reactions over there. So the reactions will be mostly initiative when they are going to break that level. So high volume area, it plays a major role. So if you start looking into high volume area, you'll be able to build many strategies on top of high volume area. One of the strategies is called as delta unwinding and delta positioning. Maybe we'll talk about those kinds of setups in tomorrow's examples. And let's move on to the topic. So typically here is an example for a high volume transactions example. So where you can find and high volume activity was happening in this zone over here. It's an typically high volume. That means price is traveling in a high volume nodes where higher activity is bringing more and more participation, more interest it is creating. That's what high volume area is all about. And low volume area means typically lower transactions, lack of liquidity zones. Maybe low volumes are a result of stops, lack of liquidity, means buyers and sellers are, there is no interest from the buyers or sellers. Or algos at times are responsible for such low price volume transactions at the extreme day high or extreme day low. Right? Or at times it could be from the aggression from the participants. So these are the end results of low volumes. And typically you can find mostly a consolidating area, right? So most of the consolidations are, for example, the consolidations in Nifty futures, which happened last Friday. So if you go back and show you the charts over here, you can find a lot of low consolidation areas in this band. You can see that lower and lower transactions, typically not in this case. But if I move a little bit, if you're able to move it down, you can find more and more low volume transactions are happening in this band. So this entire band, you could find that the volumes transactions are pretty less. So those are results of typically low interest from the participants. Maybe the bigger money is really missing from the markets. That is one scenario. Another scenario is that no interest from the participants, no news events are happening. So it's dull, boring, calm environment where nobody is actively in control in the markets. It's only traders are here and there, they are trading, they're trying to find something, they're trying to buy something, but there is no real accumulation or distribution happening from the institutions. There is no real transactions happening from the higher time frame players. Right, and so yesterday's activity is mostly characterized by such low volumes. Again, more low volume band zones here. If you look pretty closer, the volumes are less than hundreds at most of the places. So those are the results of consolidation, where there is no aggression, there is no aggressive momentum been seen inside the candle. There are no stacked buyers, there is no stacked sellers. Very rarely one momentum buyer is there and one momentum buyer and seller is there at those intervals, but really there is no stacked momentum is going on in those bands. Mostly consolidation, mostly only traders are coming and transacting at those levels. Right, so which eventually result in a low volume area. If you look into that particular table, let me try to enable the volume figures over here. If I try to enable the volume figures over here, you could see that the volumes are 1000 something and 772, 900 something and 500 something and 500 something. So it is eventually resulting in a low and lower transactions. Those lower transactions are ideally responsible for such kind of consolidation actions. Right. So now coming back to the slide here, and those are the zones where liquidity is dried up mostly, and low volumes are at times even a result of the stops as well. So here is an example where the lower volume transactions are happening. This is an example from Nifty futures, where there are zones you can see that very less and less transactions happening, and that eventually, in this case, it's shown in a dark green color. and a dark red color. Mostly lighter volumes are represented in bell order flow in the form of an thicker color, a thicker green and thicker red. Shows that it's kind of on consolidation zones. And liquidity plays a major role. It determines how the velocity of the price or the tempo of the price moves, how faster the price moves. To explain this, I need to take a whiteboard. So I'm going to pull up the whiteboard over here. So let's take about this whiteboard example here. So we're going to talk about what does it really means when I am saying about high liquidity, right? So what does a high liquidity means and what does a low liquidity means? We're going to talk about two examples here. One is high liquidity. Another one is the lower liquidity. Right. So when I'm talking about a higher liquidity, if you look at the order book itself floated with thick orders, right? So thick orders over here. Thick orders would have been floated, and thick order will be floated over here. Whereas very mild orders would be sitting in this band. So very mild orders, maybe mild orders, I'll just move it in some sort of bands like this, thin zones where a little bit of low volume would have been there. And heavy volume, probably instead of showing like this, I'll better show in the form of an lighter volume. I'm going to draw and what color? Yeah, I'll show it as in green color where lighter shades, where very less volume transactions are there. So probably very less liquidity might be sitting over here, and probably bigger liquidity might be there in the form of let's take this example as an red color. Means whenever the price is touching the zones, more limit orders are coming in this bands. So more limit orders are coming in this band. More limit orders are coming in this band. More limit orders are coming in this band. When the price is traveling in such kind of an high liquidity zones, especially the red color zones, if you assume that red colors are high liquidity zones, so when the price is reaching that zone, it's going to take more time to spend over there. So it spends more time because more liquidity comes. Every time the price moves up, more and more buyers, more and more limit orders will be coming over there. So the price movement will be very slow and steady because the constant flow of liquidity supply will be there unless it gets exhausted, right? It's not a static one, it's dynamic one. So it means when the price is moving up in those bands, more and more orders are getting floated again and again and again and again. So it means when the sellers are pushing down, when they are back up, more liquidity will be there. So again, price has to do more time. Price has to more time to spend and break out there. Once they break out, once they're coming back into the low liquidity zones, movement will be pretty much easier because it's easy to push through those levels. And again, they're going to find the liquidity zones. They're going to fight in those zones. It's going to take a lot of time for them. Price will be spending more time over there. It will be resulting in a more volume also. And again, low liquidity zones, they'll be able to cross easily. Again, high liquidity zones, they're going to take a more time. They're going to take a more time because constant flow of liquidity. Once the price is coming down, again, more limit orders will be floated at that level. So price might be taking, again, sellers will be pushing down. But when the buyers are trying to eat up, more and more buy orders will be again floated at the same level. That is why repeatedly price keeps going up and down, which will be resulted in a more volume. And when the price is traveling in a low liquid zones, it moves up. Again, it moves up. And now again, it finds a new liquidity zone. Again, it started doing some sort of an auction like this, right? So, and then price moves again. It doesn't initiate to drive over there. So that's how most of the time price moves from a low liquidity zones. High liquidity, always price used to spend more time over there. Higher liquidity can also be, let's say, if the high liquidity, if the seller's aggression is more, if the sellers are, or let's say the buyers are more aggressive, when the price is reaching this zone, when the buyers are coming up with huge volume, right? So huge volume, they'll be able to do this. If they are able to do, if the buyers are so aggressive, instead of spending more time over there, they'll be able to easily cross this level, and they'll be able to cross this level faster, and they'll be able to cross this level faster. In that case, the volume transaction is also high. At the same time, the velocity of the price is also high. whenever such kind of high volumes, high liquidity zones, it can be broken only with high aggressive participation from the players, right? So if that kind of aggressive participants is missing, then what you'll be seeing is that mostly a sideways compression auction, and then followed by an initiative drive. Again, a sideways auction or kind of a responsive auction at times, or at times it could be consolidation. And at times you're going to find some sort of an accumulation might be happening in this band before pushing the price to a newer level, right? So whereas think about if the markets are completely filled with the low volume over here. So let's say low volume liquidity is over here. A lot of low volume transactions are happening. So markets are completely filled with only low liquid zones. It's pretty easy to penetrate, right? So it's pretty easy to penetrate. Even a large block with low liquidity, it's pretty easy to penetrate. Right, so when the price is traveling in this band, you could find the difference. Even with low volume, price is able to move up. It will be very easy for them to move up pretty faster. Again, pretty faster here. Again, pretty faster here. A little bit of spend timing. Again, pretty faster here. Pretty faster here. And a little bit 10 times spending and then pretty faster. So the auction will be pretty smooth when the price is actually moving in a relative low liquidity zones. So this is how price moves in a high liquidity zones. High liquidity zones. Whereas here it's purely a low liquidity zone. Low liquidity zone. When I say high liquidity zone, I means bigger limit orders. Bigger limit orders. Takes time to fill those orders. Or we can say it's not bigger limit orders. I would say that continuous supply of limit orders at a certain price level. Continuous the supply of orders will be there. So price will be taking more time to cross those stages. Right? So not necessarily it has to be bigger limit orders. It can be continuous supply of small packets of limit orders, but at a certain price level, continuously, certain price level or a certain price zone, we can say that price zone. And again, low liquidity zones are often characterized by less amount of supply of limit orders in real time at a certain price zone. So means the flow of supply is coming here and then price moves. All of a sudden there is no supply there and the supply is available at the next level. So think of a pipe, right? So when the water is coming continuously, it's flushing out faster. We say that there is a continuous supply of the water. That means it's a high liquidity zones. Whereas when the water is coming in, it's coming in a very slow speed. The supply is not continuous, but then it's coming in the form of packets. So it's coming, but then it stops sometime. Again, price move to a certain level. Again, the supply comes. Again, it stops. Again, the supply was available at higher level, but very less amount of volume is sitting there in the form of a limit order. It's easy to bypass because there is no continuous supply of limit orders in real time at a certain price zone. That is why price is able to travel faster. And I guess this is a pretty good example to understand what liquidity is all about, right? And if you want to know much better about liquidity, and in that case, you have to learn a lot about market microstructure. So I'm going to recommend a couple of books over here for studying the market microstructure. And of course, there are a lot of materials, research material available at free of cost. And if you're really serious about understanding the institutional algorithms, right? So if you are really concerned about understanding about liquidity or execution algorithms, then the books like, I'm going to recommend a couple of books here. So maybe the books like Market Microstructure in Practice, one of the book explains. So this one is a pretty interesting book. So the Market Microstructure. which focus on topics like, right? So it gives a pretty understanding about market understanding at micro levels. So what is smart order routing, and how does the tick size matters, how tick size affects the market quality, right? And inventory driven investors and fixing auctions. Mostly it is how the institutions play the game, timing in money, and the bid ask spread difference and volatility, how the bid and ask spread affects the volatility of the markets, and how high frequency traders they operate, and metrics for balancing in liquidity among indices. So there are many things you'll be able to understand from the liquidity perspective. Most of the books are written on top of the liquidity and market impact cost, and execution algorithms. Right. So from that angle, it has been written. So if you want to really know about those uh, micro level architectures, right? So one should be really pursuing this book. It's good to know concept. Obviously, you'll be able to understand the market dynamics, and maybe your understanding about the markets improves. Nothing much, right? So, can you able to build some interesting trading strategy from this? I don't know, but definitely it's going to increase your knowledge about the way the exchange operates, the way order book. So they call it as an order book dynamics. So if you want to learn more about it, you can just Google order book dynamics, and you can learn about how the order book functions, how the price action moves in a thickly liquid markets or less liquid markets, how the price action moves. So you have a fair idea about how the order book really looks like. So there are a lot of research material has been written, and most of the research materials are available at free of cost, and a lot of mathematical models also built on top of that. So understanding the order dynamics, it explains how the limit order is basically matches with the market order. Pre-open, what happens, what kind of matching happens, and post-market, how the market matching, how the order engine matches those orders, and during the market hours, how the order matching happens. So what are those techniques used? All are which we don't realize, right? So all those minor nuances are explained in the order book dynamics. Pretty much basic things for an order flow guy. So if you want to learn, if you're more curious, just Google order book dynamics, and you will get to know about more details in the internet. Precisely, most of the exchange functions on order book dynamics, right? And so higher the liquidity, higher the interaction between the buyers and sellers. In illiquid markets will trend because they find illiquid markets always trend only to find higher liquidity zones where the liquidity price always goes and stalls there. Wherever the liquidity zone is pretty much higher, price spends more time over there. So zero liquidity zones with higher momentum act like a key support or a resistance level, which we're going to see in a couple of examples. And zero liquidity zones with lower momentum generally gets filled up, right? So again, we used to draw a key support or a resistance line for a scalping purpose. Especially, we are seeing a stuffed zeros inside a imbalance candle, right? So wherever there is a stacked imbalance, the stacked imbalance is stuffed within zeros. Those zones act like a key support or a resistance levels. So here is one of the example here. So in this example, you could see that a lot of zeros are coming in, right? So there are zeros, but especially maybe let me take a live example here. It's always good to watch in an auction imbalance zones. There are not much of auction imbalance filled with zeros lately. I don't see any bigger. Not much of stuff to zeros inside. Not much of stuff to zeros, which is coming inside the candle. Yeah, something like this. Here you are seeing In this case, you're seeing in 0 over there, which is also combining with momentum. So those are the zones where if you're seeing an absorption, if you're getting more and more absorption at those levels precisely acting like a kind of an support zones. Otherwise, not much of a level there. Because last Friday was mostly characterized by low volumes. Let me check on the surgical strike day, right? If I look into the surgical strike attack day, market was pretty volatile, and even middle of the day there was a crash is also coming in. Yeah, here is the surgical strike day, where there was exchange of exchange of fire between India and Pakistan, and you can see those days are characterized by a lot of initiative drives. Let's look into one of the initiative drives where it is stuffed with zeros. So this is the day where the Kashmir, the strike happened between India and Pakistan, and so that particular day, middle of the day, the 11 o'clock, the news came that there was an attack happened. There was an in the Indian soldiers went into Pakistan territory, and then they killed some of the terrorist camps. So by the time the market started dropping in, if you look pretty closely, are there any zeros coming in? Stuffed zeros is what I call it. There are no stuffed zeros inside. Momentum was coming in, but there are no stacked selling in. So there are no stacked selling yet, which is stuffed with zeros. Not much of stacked selling seen over there. Sellers are there, momentum sellers are there, but yeah, here one place where I'm able to see such kind of a stacked momentum selling. Nothing much otherwise. Is one place. Right, so see the selling was stacked inside the zeros, pretty tightly packed. Again, one more zone here. Again, if you look into this zone, again stack selling with zeros are coming in. So those are immediate resistance bands. Right? So every time price comes to that level, you can find an absorption which is happening. That is the zone one should be really cautious to enter reshort again. So think about this example here. So there are two places where I am able to spot such kind of zeros. So what I'll be doing here is that I'll be drawing in zones, marking that, or maybe I'll highlight these bands. I'll use a highlighter here. So highlighter, yeah. So let me highlight this zone. This zone, if I try to highlight in the zone, typically those are the zones where you can look for an absorption. As the price keeps moving there, if you find an absorption there, so it acts like a resistance zone, and price tend to fall precisely from there. So those zeros, which is coming in with a stacked zeros, that's what I'll call that as a stacked zeros, act like a potential resistance zone. When the price is approaching here, you're finding a responsive selling happening at these locations are one of the interesting places to look for in short, right? So it is not a resistance, but when the price is reaching there, you're finding an responsive auctions, or you see a lot of price is going up. Despite that, there was a responsive auction coming in the form of a momentum selling activity. Momentum sellers are showing up. Momentum sellers are showing up. From that level, responsive sellers showed up, and then price tend to keep moving down. So every time the price comes to that level, again, responsive auction kicks in over there. right? So it acts like an kind of an zone for scalping. So those zones are kind of a scalping zones. So literally those zones are kind of a scalping zones. And when the price is moving relatively fast, right? So it's usually we will tend to clear those zones and look for new zones as an kind of a support or a resistance. Okay, so coming back to the point. So the zero should be stopped to zero. So inside the momentum imbalance are very pretty close to the momentum imbalance. So then next comes the delta positioning. So delta positioning arises from an initiative auction, right? So whenever there is an initiative drive, more participants will be coming in the form of a particular packet zones, and which you'll be able to easily identify from the delta candles by putting a delta at price. So where the participants defend those positions and add to them, those are the zones where you're going to see the absorption happening at those locations. So market will always test those delta packet zones, but your entry will be when the delta packets are getting tested. By the time if you are seeing an absorption, those are the places one have to enter into those delta positioning. So let's take the example here again to explain this. Let me take an let's say the market is auctioning up with an initiative drive. During the initiative drive, we're going to see some buyers are going to onboard over here. So buyers would have been onboarded at this band, right? So when the price is moving relatively away from there, the price moved relatively away from there, and then it's testing the delta packets. When it's testing the delta packets, what you'll be finding is more of an absorption is what one might find there. So an absorption is going to find over there. That means they are doing a reloading over there. So when they are doing a reloading, naturally price tend to go up. Right. So the key here is absorption really happening over here. That's your entry point. Right. So at times that is your entry point for your trades. Right. So if there are serious buyers who done a bigger loading over here, they come and defend those levels. They allow the price to continue on the upper side. They come at the defense level at those places. Hardly they might break by 1 or 2 ticks, and then they tend to go up exactly from the delta positioning. So you're going to see a lot of absorption which happens in this initiative drive. So here is an initiative drive here. I'm going to call this an ID, initiative drive. In this initiative drive, they're going to see a delta packet positioning here. Delta positioning. So interested parties are going to position themselves in this band. And at the same location, you're going to see an absorption. Signs of absorption. Absorption of what? Absorption of the selling activity. Absorption of selling activity means you'll be finding a lot of momentum sellers. Despite the momentum seller price used to keep going up. So absorption of selling, you'll be going to witness over here. In this case, it results in a continuation of an uptrend. One have to look for an absorption behavior over there. And the next topic comes about. So you can also identify the delta positioning in the form of an packets of delta. You can see that this particular price, the participants are not there. So think this band, right? So in this band, so 569 buyers, 487 buyers, 200 buyers, 178 buyers. So the buyers are reloading their guns over there, right? So that's kind of bigger reloading. So you'll be finding in a stacked quantity, you'll be finding 300 buyers or 450 buyers and 750 buyers and probably 12, 11, 23. If the delta reading is, if your delta reading goes like this, then probably you can see at this band there are more positive deltas, right, compared to any other places. That means more participants are reloaded over here, more aggressive players loaded over here, and that's how you'll be able to understand that delta positioning happens. But delta positioning happens, that doesn't mean like it's a buying opportunity, right? If you are really looking for a scalping opportunity, you have to wait for the price to go away and then come and retest. You have to incur some sort of an auction, some sort of an absorption happens over here. Then you can think of initiating a long, and then think of looking for an some sort of a breakout from those zones. And then next comes the delta unwinding. So the delta unwinding, usually we play on event days. So before the event, what happens? The players, they position themselves in the form of a delta. As the price rises, the players comes and allocate some big packets of shares over here in the form of they would have been positioned themselves. And when the price goes up and comes back and retests those packet of zones, right? Instead of absorption, you'll be seeing consolidation, a bit of consolidation where there is no absorption happens over there. Instead, consolidation happens, and then you'll be seeing that the delta gets negative, 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 negative all the way. All the way it will be showing negative. That means the sellers are throwing their towel. So whoever entered over here, they're not willing to support over here. That you'll be able to observe from the way the price is auctioning. You'll be seeing we are going to see a lot of consolidation before a breakdown, and you will not see absorption over there. Instead, a consolidation is what you want to see. Very less and less transaction happens at that same level, and price breaking those consolidation is where you know that initiative drive. Market is preparing for the initiative drive. Probably the people who onboarded themselves over here, they're the one to liquidate in this market. So, but if you look into the cumulative delta keeps on going negative and keeps going down throughout the entire downtrend. Previously, even the cumulative delta would have been entered positive. It would have been maintaining positive throughout the trend. But as the price comes down, the cumulative delta also keeps printing negative, 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 and completely the cumulative delta turns negative, especially when the bigger packets zone is reached. Slowly, it results into some sort of consolidation and then followed by an initiative drive again. Okay, so the delta unwinding is pretty common in an event days like an RBI announcement day, or timings like the budget announcement or election announcement. So those are the zones. The delta unwinding typically it happens, or if there is any news announcement is supposed to happen, right? So the news announcement happens and price comes to an important delta packet zones. It was doing some sort of consolidation auction, so one have to be really pretty cautious over there. So delta packets is what one have to track, and it doesn't occur not much frequently in the markets, but whenever it's occurring, it shows the presence of the bigger money they are positioning at those locations. Again, trap buyer and trap seller are pretty much interesting topic. So very interesting topic, I would say that. So where the high volume buyers or sellers transacted at the day's high or lows. When I say at the day high, pretty close to the extreme. Day's high extreme or pretty close to the day lows extreme. It typically happens. It is also termed as a bad high or a bad low. It's an immediate trading opportunity, right? But they also resulted in the form of a poor way of auctioning. As I said, a good auction will be having volume, relatively low volume at the edges, and maximum volume happens at the center, and again low volume at the edges. The day's high edges and the day's low edges are characterized by typically low volume. Volume will be typically low over here, so lower volume. Whereas the center will be having high volume over here. So high volume over here at these central locations. But typically, all in a sudden, if you're going to see high volume transaction happening at the day's high or a day low, which is a poor way of facilitating price normally wherever such high transactions. So instead of having this kind of transactions, price is having an all in a sudden some big transaction happens at this day high. Typically, price used to do an sell side, but positionally they will come back and clear those references. That's how most of the trap buyer or a trap seller, most of the time they functions that way. And if you look into Nifty futures, you could see something interesting down there. Right. So what was happening here is that let's look into the recent highs. The recent high, they got this 1,568 lots got transacted at the day high. Means it is temporarily bearish. We don't know. Maybe that bearishness might continue on Monday, but eventually, positionally, they will try to capture those levels back again. That's what it means. And the similar example are also seen in Bank Nifty as well. And the Bank Nifty was hitting the day high. Almost 3,189 lots got transacted at those data point interval. So which is pretty high, which is coming at an extreme high, and you can see a lot of zeros there. It's kind of a momentum exhaustion. Most likely some volumes would have been happened over, some buying quantity would have been happened at the day high, probably 1 lot or 2 lots, but most of the transaction happens over here. So these kinds of bigger transactions are typically the results of what? Iceberg orders, right? So some random iceberg orders would have been placed at that level, and then price try to hit a zone that results in a bigger transaction, and that is also a result in a price generally dipping down temporarily on the downside. Maybe the downside could go as deep as 300 points or 400 points also, or at times 1,000 points also, but eventually they will come back to these levels. Temporarily, this is bearish, right? That's what we can understand from this example. Okay, now let's quickly look into the other topics. So I'll call that as a trapped buyer in this case. You see that it's a trapped buyer in this case, 3,189 quantity. So at times when let it be using true data or global data, if it's at times when the price is spiking up, at times you might be seeing as a bigger buying quantity or a bigger selling quantity. It doesn't matter. So usually it comes under the category of a trap buyer or a trapped seller, and which is also otherwise characterized as a poor way of facilitating the trade. So all these, it not necessarily has to come at the extreme. It can come at the extreme also. It can come a couple of ticks above these zones. When you're finding this, the candle is closing. It's an immediate short. Right? It's an immediate short. The moment you're seeing that price is hitting a day high, and the price started moving down with there's some bigger volume transaction, and price started moving down. It's an immediate short. Initiate the short and then look into the trade where your stops is pretty much at this level. And typically, you can expect a mean reversion towards VWAP levels. So one of the example we can look into here is that. So this example, candle also closed at the same level. It's an immediate short without any thinking. It's an immediate short with this as a stop loss. Price usually tend to mean revert towards the VWAP level. Hardly VWAP level was pretty much down there. VWAP was down somewhere around 27,150. But if these kinds of setup was happening around 3:15, right, or 3:15 or 3:20, 3 o'clock, eventually the at least on Monday or Tuesday. Monday is a holiday, but Tuesday there will be a continuation of such kind of trades. Especially the MR chart is coming in, so you might find that continuation of the trade which happens on Tuesday trading, probably a bit of gap down and then price tend to continue on the downside. which is what you can expect if this kind of setup is happening, especially in high volume candle, and there was a trapped buyer inside, and then the price is tripping down. In fact, it is also transforming into an MR chart. Typically, if it's coming late in the markets, the results will be carried forward on Tuesday as well towards the downside. Anyways, I'll be explaining delta positioning later on, because some of the strategies we are going to talk about delta positioning. So now we are talking about a trap buyer or a trap seller. I guess, is there any doubts on trap buyer or a trap seller? Okay. There are no doubts, then we'll move on. Maybe we'll look into one of the trap buyer, trap seller example, how it looks like, how one can identify that as an opportunity to get into trades. So let's take trap seller strategy. Let me run this video here. So it's a combination of three strategies actually. In fact, it is one of the strategy which is running here is that price here is the previous day's low. So if you look on the left hand side, you could see an you could be able to see a previous day low line around 10,830 levels. Price is dropping down towards the previous day low. Right. So just think how when the price is coming and dropping down below the previous day low, think about the behavior. So it is also one form of a strategy. It's a combination of three strategies. In fact, it's called as a breakout failure strategy, trapped seller strategy, plus momentum auction reversal strategy. So the three strategies are coming in one shot at the one place. Just look when the price is breaking, look what is happening in the order flow. The price is breaking two lows. It's breaking today's low. The today's low got established around over here, which is pretty much close to the yesterday's low. So here is the today's low, and here is the previous day's low. The same level, I'm also marking the previous day low in the order flow charts as well. So that's the previous day low. So what's going to happen now is that the price is about to break today's low as well as previous day's low in one shot. The candle is approaching and pretty close to that today's low and previous day's low. Look into the drop here. Seller momentum is gearing up. Almost it had broken the day low. Today's low has been broken with a lot of selling pressure, a decent volume, I would say that. And now you see that when it's breaking the previous day low, a lot of zeros, you'll be able to spot a lot of zeros over here. A lot of zeros came over here. All those zeros are nothing but because of stop hunting. And all of a sudden, you could be going to see this 2041 lots, right? So a trapped seller there, all of a sudden it stops. That's an immediate long. Once you see this market, it's an immediate long, and go for a long opportunity, because most likely you're going to see a breakout failure. And at the same time, you're going to see the volumes are almost 4,082 lots got transacted over here. A good volume, the high volatile candle, followed by that next is forming almost like an inside bar. An inside bar with a positive candle. We call that as a momentum auction reversal strategy. Whereas a high volatile negative bar, it is offsetted with an positive candle. So I guess the candle won't have to wait for the candle to turn positive. Yeah, it's almost pretty much positive. And so that is a clear entry point for an long to initiate. So already here is one more long initiate. The momentum auction reversal here confirms that it's going to be a long trade, and from there onwards we start seeing delta building up. The players are positioning themselves with a higher delta, higher positive delta is coming in, price is also pushing up. Usually tend to revisit towards those VWAP level, and at times it could do even much bigger. It depends upon the context on how to play this game. Without context, one can play blindly towards VWAP, but it requires a great context sense to play for higher targets. Right, so as I said, it's a combination of 3 strategies. It's a combination of breakout failure strategy. There was a breakout failure at the previous day's low, and it also comes up with a trapped seller. Seller got trapped at the day's low, and it is also a combination of a momentum auction reversal, which happens in the which confirmation came at 110 candle, because there was a big downside candle followed by a positive doji comes in the form of a positive bar. That is why the momentum auction reversal happens over there. And again, so you can see that the zero zones which is stuffed inside that momentum, that zone act like a support zone. So support band, if at all price is coming there, reaching there, what you have to look for is an kind of an absorption. If absorption is at times it happens, at times it doesn't happen. If absorption is happening, then that is again one more re-entry point for towards longs. So those are the places where you can find the stacked momentum as buying entry points. Right. So I'm gonna do a couple of quickly. I'm gonna finish this video. Again, price is coming and touching that zone. You can see the seller absorption is happening at that support band, and it tend to bounce back from there. Right, so it exactly bounces back from there. So that is one more re-entry point. So it is also a combination of 2 strategies. One is that zero liquidity band, where it is coming with a stacked momentum buying, and where the support band is coming and price is testing exactly at those levels, right? And you can see that absorption happening. A lot of selling happens, which is completely absorbed by the buyers, and buyers took the price way up. Maybe all this decision has to happen during live markets. How do I say that? It's seller absorption. You can see the delta is negative. Sellers are pushing the price down, but despite that, price is holding up. Next to the zone also, let me pass the video over here. See that I think I have to go a little bit back. Okay. So there are other clues. What you'll be getting here is that 199 lots got traded at the low, 23 lots got traded at the lows. And so these are the signs that the selling activity was there. Again, price going up, again, selling activity was there. Now the selling activity is much reduced and price is moving out of this band. It is an clear longs there. So a lot of reloading happens over there, especially at those those momentum auction zones. Maybe the smart money would have been positioned themselves at those locations. So those locations, if you look pretty much back, so those locations might be dominated by the some smart money would have been entered in this the entire band. Some smart money would have been entered in all those locations. They might come. They push the price really hard. That's for the reason you're getting a lot of stack momentum from here to here. A lot of stack momentum coming over here. So when the price is moving away, and then coming back to the zone, you're getting a lot of reloading happening over here. And again, all the sellers are come. A responsive auction is what you're going to see over the responsive auction, and then price again takes initiative directions over there. So that's one interesting example. Yes, I'll be uploading all those drill videos in a separate portal, and I'll be mailing you. And if at all I'm doing any drill videos, you'll be getting access to the next 1 year. So thereby you'll be able to learn how we are seeing the markets, and from the drill videos will be kind of an explainer to revise your own to revise your strategies much better and better and better. Okay, so coming back. Let me close this stuff here, and we'll get back to the basics. So that's what the trap buyer or a trap seller is all about. And exhaustive highs or exhaustive lows, right? So this is also one form of a momentum exhaustion. At times it is a result of a stopped out rates. So things get exaggerated. Price response at extremes with wild swings. Often this exhaustive high is characterized with a bigger high volatile candle, right? So where the highest delta, highest volume, and wildest price rotations, exhaustion market tend to take a break first. For example, to explain this exhaustive auction, there are 3 different ways one can spot an exhaustive auction. So one of the way is like an exhaustive candle is followed by a delta divergence. So let me take an example from Nifty March contract. At the opening of the candle, if you look pretty closely at the opening of the candle, let's talk about last 15 minutes of activity yesterday. So you could see that the exhaustion high was driven up by so a lot of zeros inside, which is one form of a stop hunting, and more absorption is happening at this highs, right? So buyers are the big buyers are there. So you see that big buyers are there, and more buying activity is happening over here. And despite that, market started going sideways. So more buying activity is over here, and a lot of absorption. That means a lot of absorption happens. Price is going completely sideways. That means the entire buying activity has been completely absorbed. And what you're seeing is a responsive selling. Along with that, you could see a delta divergence also. So it's a high volatile candle. The volatility of the candle is high. In fact, you are seeing a lot of initiative drive. You're seeing a lot of zero liquidity zones over here, mostly a result of a stop hunting. Probably at the high of the candle, huge volume is getting transacted. That means the selling volume is getting absorbed over there. Otherwise, it would have been a straight up and up. Instead of going that, market started moving on the downside. So a lot of responsive sellers are showing up. Despite this huge buying activity, price is dropping down, which is a responsive activity. Again, price is maintaining down. You can see that the delta is completely maintaining negative here. All the zones, the delta was negative. All these zones, the delta was negative. That means responsive sellers are in control at those places. And you can also see an exhaustion high. It is an exhaustion high. So that it's because it's a big range candle, and absorption was happening at those top. And followed by that, the second candle was a delta divergence candle. Means the price was hitting a new high, but if you look at the delta was negative. And if the delta is negative and price is hitting a day high, that means especially a combination of exhaustion high and a combination of delta divergence, it makes an as one of the good zone to look for a scalping zone to look for a trade. Your stops comes at that high of the candle. The stops is nothing but typically that high of the candle. Maybe if I draw a line here, my stops would be coming. Yesterday we talked about this, right? So yesterday we talked about this delta divergence. We also shared that in the Slack. So your immediate stop is this band. That's your stop loss for shorts. And look for a trading opportunity, especially towards the look for a scalping opportunity for a downside confirmation. So then what was happening here is that market was moving in a consolidation fashion, and then it was breaking down slowly. it takes a long time to break down. So it was until then markets was moving in a very low consolidation fashion. Look at the volume was 100, 500, 1,500, 600, 500 plus, some 800 plus, 700 plus, 300 plus, 200 plus, 252 plus. All these are signs of a consolidation. Market was consolidating, and then during middle of the day, it was slowly dripping down. So especially there is a saying there that it's tough to continue in the low volume zone. So the price is breaking down with the low volume. You see that price is coming down. And look at the volume, how the volume is coming in. It's like 250, 703, 904, 531 lots. Now, last two candles, the volumes are picking up, which is 1,600 lots and 2,000 lots. When the 2,000 lots are getting traded, you could find big volatility was coming in. It's not much of a big volatility candle, but then you could see some delta positioning happens there, right? So some positioning happens over there. A lot of absorption happened at this lows. Absorption was happening at this low. You see that 1,000 quantity, almost 1,000 quantity got traded in that two blocks, which is kind of a trapped seller again. A trapped seller is coming at the day's low, which is also broken the today's low. So it's also taken at the today's low. So today's low was exactly here. If I draw a line here, so here is my today's low. This is today's low. So think about when the today's low is breaking, you are getting a trapped buyer, a trapped seller, right? So it's an immediate long. It is an immediate long. By the way, because it is kind of a trapped seller activity here at this location, it is a trapped seller. So you can take this as a stop, and you can in fact think about long towards VWAP levels. So VWAP level is done, you're out of the game. So again, one more time they come and test this level. Day low is not broken. This time they went on testing the VWAP levels. Right? So once they're done with the VWAP level, but you also understand that this is a kind of a trapped buyer, trapped seller at the day low. So typically they will again come back to revisit those levels. Right. So and when they are coming up also, they have a similar structure there. Again, when they are hitting the day high, price was again now hitting a day high. A fresh day high has been hit at this level. So this is the previous that day's high, which we've taken as a previous top. When they're hitting the day high, again they're coming up with a bigger volume. It's an immediate short. It's an immediate short over here, and price tend to fall down typically, and scalping opportunity. And I guess this will have an impact on the Tuesday trading as well. Right. So Tuesday trading probably they might attempt one more time testing today's low. How they are going and testing the today's low, it matters. Whether they are going to fall 100 points from here or 200 points from here, no matter what. Always the immediate result is an kind of a fall. They can even fall 3% also, 5% also fall from here. But how they're going to fall, it matters a lot. Let's see how the activity is going to happen during the month of March. I'm believing some sort of a volatility is likely to kick in on the downside. Okay, so that's what the trap buyer and trap seller. A classical example is Friday's one, both in Nifty and Bank Nifty. And classical example to understand exhaustive high also yesterday's topic. An exhaustive high can happen in 3 varieties of ways, right? So I explained already in a whiteboard session. I'll repeat it again. I'm going to take a whiteboard over here. A typical exhaustion high happens in the form of the very first way one can think of this. First reason is to form a high volatile candle. The candle closes almost at the high if it's a positive candle. And then the next candle, it makes really sense. So let's say the next candle, it forms, let's say the next candle also, it was a bit positive over here, but then let's say it was having an ticks where the delta is negative. So if the delta is negative over here, then we can say like momentum exhaustion happening at this delta divergence. We call that as a delta divergence because price is hitting day high. So an exhaustion high is characterized by what? exhaustion high. One is high volatile candle. With a lot of initiative drive, followed by delta divergence. The example which I shown you is in delta divergence. The other example is like this is the first example. This is the first example here. The second example will be second example. So in case of a second example, typically the bar will result in the next bar will be the result of an inside bar. The next bar become an inside bar, and then it forms a momentum auction reversal. It forms a momentum auction reversal. Momentum auction reversal is also one form of an exhaustion high, right? A high volatile candle. Next bar is an inside bar. So I'm going to call this as a high volatile candle followed by a reverse inside bar. That means if the high volatile candle is positive, the inside bar is negative. If the high volatile candle is negative, the inside bar is positive, and that's why we'll be able to say that it's one form of a momentum exhaustion, right? So momentum exhaustion happened, or at times the top of the levels, right? So the top of the levels will be characterized by a lot of zeros over here. A lot of zeros here. Again, zeros will be coming on one side. You'll be finding the zeros over there. That is also one form of an aggression from the participant saying that momentum exhaustion is happening. So the classical example is the recent Nifty futures. So where you're going to see these kinds of exhaustion highs in the form of in the form of zeros over here. So those kinds of zeros, which I'm going to highlight over here. Oh, it's not happening. Okay, I have to go back to the screen share. I'll go back to the screen. So the classical example from Nifty futures is here, where you're going to find the zeros at the highs. It's a nice volatile candle, right? And then it's forming by an inside bar. That inside bar, which is nothing but an kind of an example for a momentum auction reversal. So you're going to get that momentum auction reversal alert as well, right? So those are the typical characteristics. The same case with Bank Nifty as well. If you look into the Bank Nifty charts, you're going to find a lot of zeros over here. You find a lot of zeros on the sell side, and of course, on the, it doesn't matter whether you're getting on whatever the side. At least the sell side should be having a lot of zeros over there, and there was a big momentum candle. Selling stops, and then that itself is a sign of a momentum exhaustion. Momentum exhaustion is not an end of the day high, but that means we are pretty close to the day high. The next bar forms a momentum auction reversal. It's a negative bar, whereas the previous bar was a high volatile positive bar. The second bar was a negative bar, and it forms an MR short. So it's one form of a momentum exhaustion happens in the markets. And that's a pretty classical example for an exhaustion high. And the last way is like there are one more way you can anticipate an exhaustion high. In the form of an let's say, let me go back to the whiteboard. So the last way you can understand here is, let me clear all these drawings. Yeah, let's say the same high volatile bar was there, and instead you're going to find a lot of inside bars. You're going to find a lot of inside bars within this. You'll find inside bars, and followed by one more inside bar, one more inside bar. And if you look at the delta will be getting negative everywhere. So the delta reading will be negative in this candle, and will be negative in this candle, and will be negative in this candle. So you're going to see a pack of inside bars. It's also one form of an absorption. That responsive selling is happening. So price tend to hit the day high. Despite hitting the day high, your delta is getting negative, negative, negative with a decent volume. That means absorption of buying is happening. That means responsive selling is happening in that case. So which is one way where we spot, like, after a high volatile candle, after a good high volatile candle, high volatile candle followed by streak of inside bars, right? So inside bars with opposite delta, opposite directional delta. So if the trend is positive, then we're gonna get a delta is negative, negative, negative continuously. That is one form of absorption. Here I would say that in this case I would say that buyer absorption happens. Buyer absorption. That means buyer actually is getting absorbed, or we can also say like responsive selling happens. Selling happens. Right? That is another way where we can start on potential trend reversal. It's also characterized with trapped buyer or a trap seller. So high volatile candle, contains trapped buyer or a trapped seller. So that is also one another indication that it is an exhaustion high. Right? Any other questions on exhaustion high? So these are the four ways you can understand how an exhaustion high typically happens in the markets. So repeatedly, exhaustion highs are an indication that pretty much we are pretty close to that swing high, and that gives an opportunity to scalp on the reverse side, which most of the time it gives a very tight risk management, tight risk stop loss. And very frequently you can find this pattern every other day, either in Nifty or Bank Nifty, somewhere else. This kind of exhaustion pattern occurs. Your duty is to find such kind of patterns and take advantage of those patterns. Right. So, anyways, we'll be one of the example what we've seen is in the Nifty chart, and we looked into the delta high volatile candle and followed by that delta divergence. And that is our example. We looked into that. The other example which we looked into that is in the same day, last Friday, we looked into high volatile candle which contains a trap buyer or a trap seller. At the same time, high volatile candle followed by a reverse inside bar. So at times you're going to see all kind of combinations, right? So that is what it increases your broader understanding about the markets, that this top has been achieved. Probably this could be a swing top, and then I'm going to reverse my position immediately. So you can take some contra bets over there, and one can make use of those. With a very tight stop loss, one will be able to play using exhaustion kind of high kind of methodology. I prefer to do that because most of the people, they fear to take a trade, especially when they're seeing in that kind of high volatile candle. And people mostly they back off after looking into this high volatile candle, especially with which is coming with a high volume. But if you know the nuances of how to handle the exhaustion high, the four patterns which we discussed over here, which helps you to go on short even with that big volatile candle, you will be able to believe in those contexts, and you'll be able to take a trade with a very tight risk management in place. You'll be able to go and find some good trades over there. Where a regular trader who mostly depends upon indicator alone, they are not going to make a decision over there because it's pretty tough to go and take a decision only based upon indicators. But if you have the real buyers and sellers, and if you know the behavior of the buyers and sellers after a high volatile candle, and you're able to spot an exhaustion high, that's a pretty interesting zone to watch out, I would say that. But definitely it's going to be a tough game if somebody is going to look from the indicators, no matter what, how much ever you want to look from a trend following indicator, how much ever you want to look from a stochastics, it's not going to give you any much clues, right? So it's going to give a very late confirmation if you're going to use a price-based indicators there. And that is why precisely order flow comes into the play. That's why I say like order flow is one of the leading indicators in the markets, right? So you know much better before the market turns that you have an entire idea that this market is going to turn in a very, very short term perspective, right? And so that's what the exhaustion high is all about. Maybe typically we look into some more examples tomorrow about exhaustion high. Some of the examples from Bank Nifty February, I'll try to load it for you in tomorrow's session. Let's get back to the screen and we'll discuss a couple of more context. So that's exhaustion high. I think we are pretty close to the end of the session here. I think we can break today, and again, tomorrow there will be a half a day session where we are going to discuss about only about strategy. So most of the basic principles we already discussed. Some of the basic principles are still pending there to get the context right. So we're going to talk about some of the context driven how to take trades based upon the context, and how to believe in those principles and make use of those principles, how tighter a stop loss one can manage. That's what we're going to talk in tomorrow's session. And if you have any questions, I'm going to unmute. You can unmute yourself and you can ask questions now. Yeah.
Hello, Rajendra sir.
Yes.
I know you have covered this in the last week. Will you be repeating the same thing, like combining market profile and order flow? How to use along with the context of market profile and order flow, combining?
We discussed in the last week, right? So
that's correct. Yeah.
Those recorded videos.
Yeah. Okay.
Same. But tomorrow we're going to look into only the order flow strategies, right? So only the order flow strategy.
Okay.
We are almost some 10 strategies. We are look one by one. And a couple of topics are pending, like unfinished auctions, and some more similar topics are pending there, which we are going to deal only from the strategy perspective. We're going to talk tomorrow.
Okay, great. Thank you, sir.
Right, so we'll be meeting again tomorrow morning, 10 o'clock. And if there are any questions, you can always ask in Slack.
Only one question, sir.
Yeah, please.
Sir, in stop hunting, will that be revisited, sir? When we are seeing some stop hunting zones?
Mostly it gets revisited.
Most of the time it will be revisited, no, sir?
Yes. Most of the stop hunting zones will be revisited. So one of the worst place to take a trade is once you're seeing the stop out trade and you're jumping into conclusion. Most likely price comes and revisit those zones.
Because when the starting of the market, no, so there will be many zeros in the starting period.
So, no, that is not a stop hunting. Stop hunting usually happens in the middle of the day. So, for example, you can see that this is a stop hunting, and the price is hitting the day high. You can see in this example, the stop hunting is happening in this block. So probably I'll put the block here. Finding a lot of zeros here. Price is hitting a day high, and it's resulting in a lot of stop hunting is happening. And you see that price are again coming back to revisit those zones. Not only here, if I go back to the past, around 9 o'clock. So similar stop hunting, it came at the opening here as well. You can see a lot over here.
Yes, sir.
Right. So typically those levels has been revisited on that same day. See this zero zones.
But this is the opening candle, no, sir? That is the only thing I'm asking.
This is not the opening candle. This is the second candle after the open.
After the open, the second candle has so much zeros, it will be revisited, no, sir?
See, I'm sorry, not this one. This is yesterday's one or what?
This is yesterday's, no, sir?
Not this one. There was one more, probably Nifty it was there. Nifty, let me go and show the Nifty. The Nifty second candle has a lot many zeros. Yeah, so the second candle here.
Yes, sir.
You find a lot of zeros here. That's mostly result of a stop hunting.
But the starting candle should not be considered, no, sir?
The starting candle we don't consider. Right? So when this kind of stop hunting is happening during the day or middle of the day, those zones always tend to revisit back. So not a wise one to reinitiate. Don't expect that as a support or resistance, that price to continue. It always comes and revisit those levels.
Okay, sir. Thank you, sir.
Rajendra, I have one question regarding this imbalance. We talked about the stacked zeros, right?
Yes.
So can you just draw it in the whiteboard? I missed it. I just want to see how does that happen, the pattern.
Okay.
Is it consecutive or alternative? I did not get it.
So if I try to do it in a whiteboard, it will be looking like this probably, and let's say, let me draw an here, and let me also draw an one more block here. So let's say there are a lot of momentum blocks coming in. So here is one momentum coming in, and one more momentum coming in over here in these two blocks, and one more momentum coming in this block. And if it is stuffed with a 0, assume that one of the value inside this block is 0. So which is stuffed in between over here, and we have some random value. Let's say some 20 over here, and some 100 over here, and some, let's say some 30 over here, and let's say some 50 over here. Whereas the momentum blocks are having some bigger quantity, always more than 10 times. Let's say 1000 volumes over here, and let's say some 400 over here, and let's say something like 100 over here. So when such kind of momentum blocks are coming in, and the price typically they tend to rise from there, but always those packets, the market is revisiting. The markets are revisiting the zone, and you're going to see a lot of absorption of the selling quantity. Right? So all these lot of sellers which are coming in are getting absorbed, and prices again pushed back outside. That means the interested parties who are initiated trades over here, and over here, they are mostly interested parties. So what you're going to see here is that when the price is coming back into the zone, you have to find an absorption of selling. Absorption of selling activity. That means despite a lot of selling, price is going to stop, and you could be feeling that a lot of selling activity, price stops, again goes back, and now selling happens. The less and less selling activity will be there. Price goes up, and it goes up, and it keeps going up. Right. So that is what you're going to see over there. Price is going to spend a little time over there before continuing in the direction of the momentum. So your absorption is the place for the entry there. So you have to literally look for an absorption so that the interested parties comes and support at those locations. Otherwise, just because you have that, and 0 is one example. Let it be 0 or without any such zeros. Without that zeros, you might have one more block also over here. One more momentum block also might be here. Those momentum block also consider as an interested party zones where you're going to look for an absorption of selling, right? So it doesn't matter whether it is 0 stuffed inside or not. But if it is 0 stuffed inside, definitely it may not be a stacked momentum block, but still we'll be consider that as a kind of a stacked momentum block. It is one form of a stacked momentum block, as simple as that, and that block is where one have to look for a absorption of selling. It is not because of 0 that even this absence of 0, we call that as a stacked momentum buying. Even if the quantity is 1 over here, assume that not only 0, even if the quantity is 1 over here, then still that value will be considered as a kind of an stuffed zeros, kind of a stuffed 0 or stuffed 1, stuffed 2, something like that. Still, this block will be considered as a momentum block. Context-wise, this block is considered as a momentum block. This entire block will be considered as a momentum block, and price coming to that zone, one have to look for an absorption of the selling for a scalping opportunity.
Okay, thank you.
Right. So
an exhaustion. Sir.
Yes.
Hello.
Yeah, tell me. Yeah, please go ahead.
No, sir. Hello.
Yeah, I'm able to hear you.
In exhaustion,
Exhaustion, yes.
you covered 3 things are there,
4 things.
but exactly exhaustion I didn't catch. I don't know why. Other things I understood. Exhaustion, low and high, exactly what? Other things I know that.
It's one form of a momentum exhaustion. So here, look into this case. The buyers are running through. It's an initiative drive which is happening here. In this example, they're running through the liquidity, and then the price is looking into. They completely exhausted that order book, right? So, and then what is happening here is that almost there is no follow through, and the absorption start kicking in. The entire buying activity has been absorbed, and now counter trend auction proceeds. That is why one form of an exhaustion happens. So if you look back into the slide, what is an exhaustion is all about? Exhaustion low or high are a result of an stopped out rates. So think exaggerated price response at the extremes with wild swings. It is one form of momentum exhaustion which happens pretty close to the day's high or a day's low.
Okay.
Right. So it's one form of a momentum exhaustion. Right. So we've seen 4 types. Right. So all those 4 types are the zones where most of the day high, day low, which is coming especially with a high volatile candle. Right. So a day high, day low can be formed any other way. But if it is happening with a very high volatility like this, the bar started with low and it spiked up almost this bar was almost 30-point range. When that 30-point range is coming up, and then all of a sudden you're seeing absorption of the selling, absorption of the entire buying quantity, and which is a typically, and moreover in this case, it is coming in the form of a delta divergence, which is one form of a momentum exhaustion. That means big volume candle, it got stopped, and selling is now about to resume back. That's what it means.
Okay. It's almost momentum reversal in one way.
Yeah, it's almost it's not a momentum auction reversal or a momentum reversal. That there are 2 different strategies. This is a momentum candle.
Okay.
Yeah, that is very common in almost all the 3 strategies.
Okay.
But the thing is that it is coming up with a delta divergence. So what does a delta divergence means?
Yes.
Price is hitting a new high, whereas the delta becomes negative.
So delta divergence is a requirement here.
Yeah, delta divergence is one form of requirement. It can come in any other form. As I mentioned, there are 4 forms of price could hit a momentum exhaustion in 4 different varieties.
Okay.
One of the variety is a high momentum candle followed by a delta divergence.
Okay. Other 3 things will be covered, or it is already covered? Huh?
It's already covered. One is momentum auction reversal. We covered that.
Yes.
One is in the form of a reverse inside bar. We covered that.
Yes.
Almost every other form has been covered.
Okay.
Yeah, anyways, tomorrow we'll be discussing more and more. But yeah, these are basic principles. So almost we covered whatever we had spoken so far.
Okay.
Right. So tomorrow we're gonna look into only from the strategy perspective. We're gonna look into mostly a scalping, or what are the plays where the price makes a complete reversal. What are the scenarios? Only from the order flow perspective, we're going to look into that. And market profile, we already have the video. I would recommend you to go back and see those videos again. Anyways, I'll be attaching the market profile video also along with that in a new page. I'll be sending the uploaded videos in a new page, and I'll be attaching the old market profile video along with that. Right?
Okay.
So thank you, everyone.
Only one last question, sir. What is HVN in volume spread analysis, sir?
HVN is nothing but high volume nodes.
High volume nodes, sir?
Yeah, high volume node. So in this case, so look at this example. The red. So these are the zones where high volume are happening over here. If you want me to draw where the high volume is happening in this band, I would say that high volume happens over here. The high volume is happening over here. So these are the 2 zones one have to watch out for. So where the price is stopped once and it is also stopped again, and high volume nodes. Typically, traders are responsible for those high volume nodes. Temporarily it goes up, but permanently they will be taken out. At times it will be taken out in the form of a gap down.
Okay, sir. Thank you, sir.
Right. Yeah. Thank you.